There is debt out there. There's debt out there from life companies. There's debt out there from CMBS shops. There's debt out there from banks. But, the projects really, they need to make sense, right? Which is kind of an obvious statement to make. But you need to have a sponsor who has some management experience, who's well capitalized, who can, kind of absorb a downturn in the market. It has to move. Cap rates are going to have to start creeping up. I think you're going to see a slowdown in deal volume across pretty much all property types, but probably more specifically multifamily at first.
This episode brought to you by Suites at Madison. Meeting and conference rooms for rent by the hour, week, month, or year. Suites at Madison, where business gets done. Check them out at www.downtowntampaoffice.com. Now, on to the show.
You are listening to the Invest Florida Real Estate Show, covering topics in lending, buy and sell strategies, property management, hot markets, and tips and tools to guide you along the way on your path to real estate success. You want Florida investment real estate talk? You have come to the right place. And now, our hosts, Eric Odom and Steven Silverman.
Hello and welcome to another episode of the Invest Florida Real Estate Show. This is your co-host, Eric Odom, along with Steven Silverman. Steven, had a little activity on your side of the ledger this last couple of weeks?
Well, we had our weekly meeting today. One of our associates brought in a deal on a retail center. That's interesting for us because it fits into the space that we play. We can lease it up and then hopefully go into property management.
Well, yeah, it's got some vacancy in it, and that's going to be the first task is to get the space stabilized, get the center stabilized, and then take over the management of it. That's sort of what we do. It's seems to be our niche. I'm not sure that we really thought about it when we got into it, but it seems that we're pretty good at turning some of these plazas around and finding tenants for it. Everybody talks about how bad retail is. I don't find it to be that bad at all. You just have to work a little harder at trying to find the tenants that are going to go into the space. Sometimes you got to subdivide some of those, demise some of those larger boxes because the demand for box size for square footage is lower than it was 15 years ago. But that's okay. I mean, if you've got deep pockets from the owner's side, this is certainly something that we've done in the past and try to help those owners stabilize and take over the property management.
Well, the end of the day, to really make life simpler, and sometimes it's more painful, is the quality of the tenants. Sometimes you have to say no, and you have to go after ones who will actually bring up the value of the property.
Yeah, no doubt about it. And the ones that are active right now, guys, if you're retail plazas, there's. If you'd asked 3 years ago, they would have said Wawa's, Starbucks, the
dollar stores,
Walmart. Dollar stores were big. That's changed now. A lot of the national guys have really, really slowed down in terms of their expansions. And what's happening right now is the regional and local guys, and those guys tend not to have as many resources to go out and find deals. So you have to work a little harder to find those folks. They don't have dedicated real estate professionals to going out and helping them find deals, but they're pretty darn good tenants. I mean, you get somebody who's got 4 or 5 locations and, what they might be anything from a shoe store to a nail salon to a tanning parlor to check cashing, whatever it might be. But they don't have professional real estate guys, and you got to work a little harder. So if you're a retail plaza guy, get off your rear and go make some telephone calls. It's not as easy as just showing up to a convention and talking to the Dollar General guys anymore. Those days are over. You're going to have to dig a little deeper. So, guys, change the subject on it a little bit. If you've not had the opportunity, we would greatly appreciate that you go to Stitcher, iTunes, Google Play, give us a review. Those are helpful when guests are determining whether they're going to invest time with us on the show and come and talk to us. They want to see that you guys are paying attention. So those reviews help us a lot in attracting guests, and we don't really do this for money. There's no charge for this, and this is the one way we ask for you to try to help us out. And it's not really called a payment, but because it really is something you guys get back in return by quality guests. So leave us a return if you or a review if you've not had a chance to do that. And Stephen, is there anything else before we get rolling in with our guest today?
Well, Eric, we were talking about what we should do on this podcast and evaluating options and what's timely, and you had a capital idea.
Oh, capital idea.
So let's roll into that.
Okay. Well, you guys now have the pun/hint. We are talking about debt and capital structure today. So hope you guys enjoy, and we'll be back later with you after our guest.
Today we have with us Casey Siggins. Casey specializes in the origination and placement of debt and equity for all types of income-producing real estate investments. He has a diverse knowledge of financial models and technology, as well as tactical approaches to arranging debt and equity. Casey has been integral in the integration and development of Franklin Street's dedicated collaborative customer relations management system. His team has closed more than 50 transactions valued in excess of $200 million. He is actively involved in the Tampa real estate community, and we're happy to have him on our show today. Casey, welcome to the Invest Florida show.
Thank you. I'm happy to be here.
Casey, really appreciate you taking the time and investing it with us today. Tell us a little bit about Franklin Street on the debt side, and we know about them as a brokerage and know the rapid growth that's gone on over their brokerage side. But lots of folks don't know about you guys on the debt side. So why don't you give us a 30,000-foot view of what you guys focus on the debt side of the business?
Sure, I'd be happy to. Franklin Street, we started 11 years ago, right into the teeth of the downturn of the recession. We started here in Tampa. Our headquarters are in Tampa. We now have offices in South Florida, Orlando, Jacksonville, and Atlanta. We specialize in really servicing clients from the beginning of a property life cycle through the end of it. We'll sell you a property. We will finance that property for you. We'll insure it. We'll manage it. We'll lease it. And then we'll sell it for you on the backside. What I specialize in, specifically is capital markets. I'm on the debt and equity team. So what I do on a day-to-day basis is I work with private to mid-sized clients, occasionally institutional style clients, but mostly private to mid-sized clients on arranging the capital stack for an acquisition, a refinance, or a development project.
Okay. And recently, how many folks do you have in the capital markets?
Currently, it's myself, my partner Ben, and two of our counterparts in South Florida.
Gotcha.
So there's four of us on the team total.
Okay. And so you do both debt and equity.
We do. I'd say right now, probably 90 to 95% of our business is focused on the debt side. But we are looking at a few different equity projects, or equity needs. And, we are very capable of arranging equity and really arranging the entire capital stack for a client.
And so if you're doing on the equity side, what are you looking for? What do you think is sort of your ideal what's the breadbasket there for you guys on the equity side if you're to help with an equity raise?
So, I would say
I'm talking about the profile.
Sure. The profile is, someone who, obviously has a good idea and, for whatever reason, they don't have the financial means to put this idea into motion. Right. So they're going to reach out to us and they're going to say, here's my idea. Here's the point that I've gotten this project, this idea to, and I need help bringing this to, realization. So what we'll do from there is we'll have a conversation about the debt. We'll have a conversation about the equity, what kind of equity partner that this particular client is looking for. And, we really tailor who we market an opportunity to based on what the strategy of the property is and what the developer or the client is looking for.
Can you give us an example of just some of the types of properties you've looked at with regard to raising equity?
Sure. We've looked at mixed use projects. We've looked at multifamily projects. We're looking at a retail project right now, smaller retail project. We looked at a hotel last year, didn't come to fruition, but, I would say on the equity side, multifamily, retail, and self-storage has been really our most exposure.
Gotcha. And so on the retail side, what are you finding investors, their appetite for retail? If you listen to the press, retail is going to hell in a handbasket. Of course, we know in this industry that that's nonsense. But if you pick up Time Magazine, it wasn't that long ago, that was 3 weeks ago, Newsweek, that the end of retail is, I think, was the cover. And there's a lot of nervousness about retail and what's going on with it. Everybody in this room, and I hope people listening understand that that's complete bunk. It's changing. That's without question. But what are you finding on both the debt and the equity side in relation to retail, the appetite?
Yeah, Eric, I think you hit the nail on the head there. The retail market is certainly changing. The type of tenants, the size of the spaces, there's rapid evolving in the industry right now. Really what we're seeing on the debt side for retail is there is debt out there. There's debt out there from life companies. There's debt out there from CMBS shops. There's debt out there from banks. But, the projects really, they need to make sense, right? Which is kind of an obvious statement to make. But you need to have a sponsor who has some management experience, who's well capitalized, who can, kind of absorb a downturn in the market. And if you have a project and a client that kind of checks off the necessary boxes, now I'm not saying you have to check off every single box. There's ways, that you can, get around some potential issues. But if you have someone a client who really, has a center that has value add potential, that has, good cash flow, there are debt partners out there for you. On the equity side, I think there's a lot of equity, JV partners, preferred equity partners who see an opportunity in retail, because, you are seeing lower leverage debt commitments, and to come in and kind of fill up a capital stack on a project that they feel is very secure, and there is going to be demand for space in that center. There's an opportunity, right, to come in and make a very solid return on a pretty secure asset. So, we're still seeing strong appetite for retail projects in both the debt and equity side.
Gotcha. Now, we like to do an episode every year on the debt markets where, ideally we're hitting it in the first quarter. We're a little bit late this year, but I don't think it's too late for us to talk about it. The MBA conference, which typically happens towards the end of February, I believe, it usually is that the watering hole where everybody from the industry on the debt side comes together and talks about what they see and the outlook for the rest of the year. So you actually went this year, correct?
Absolutely. Yep. I was there. That was held in early February out in San Diego, California. It was a very well attended conference, both from direct lenders, mortgage brokers, mortgage bankers, service providers, vendors. It was, I think if I'm remembering correctly, one of the largest conferences that they've had since the downturn. So, the MBA.
I don't know if that's good or bad.
It depends on how you look at it. I found it to be good. We had, a tremendous amount of very useful and impactful conversations on how we are operating our business, and these conversations are dictating the way that, we kind of view the market right now. It's kind of a whirlwind when you're out there. You're meeting with a new lender every 15 to 20 minutes. And, it's hard to keep track of all your notes and who's like saying what. Dating. Exactly. That's a very good way to put it. It is speed dating for mortgage bankers and lenders. Here's what we're doing. Here's what we're looking for. If you guys have anything in the pipeline, send it over.
Yeah. Then you go out and make out somewhere.
Exactly.
Oh, please, come on, guys. Come on.
No, but it's a
I've just got this vision of the finance geek in there and just keep denigrating, sliding down the hill.
You're not totally off, but it's like I said, it's a very well attended conference. It's very useful, but you gotta put in the work. You gotta set up the meetings and really target who you want to meet with based on your business plan. At Franklin Street, we do a lot of multifamily, a lot of retail, and so we target agency lenders, we target banks, debt funds, that are going to be able to service those clients and those projects. But yes, it was, I enjoyed myself out there very much.
So, we're brokers out in the field and, we read like everybody else and talk to customers, our clients, so interest rates are going up and the world's changing. And yet really there's so many different segments of the capital markets. Maybe you could just talk to us about what's going on in some of the more important segments, and we'll learn what's going on. And
give us a 30,000 foot view of the attitude and the mentality at this year's conference, and then we'll start covering some of the hot points. Like the agency obviously is usually at the top of everybody's mind.
Sure. Yeah. I would say that the overwhelming feeling at the conference was that, we are probably headed towards the latter stages of this cycle, right? Everyone kind of has an understanding and is expecting interest rates to move. Now, since the conference, I think, we're probably about 30 to 40 basis points higher on the 10-year treasury than we were at that time. So, finally, we're starting to see some of that expected movement in U.S. treasuries. The 10-year just crossed 3% today for the first time since 2014. I would say that we've really, as an industry, we've really kind of braced ourselves for this interest rate increase. And as interest rates continue to increase, we're going to see, obviously spreads contract a little bit, but for the most part, rates are, we're going to start seeing more deals with a 5 handle versus a 4 handle, which has been the norm for the past, call it 3 to 4 years. We're going to start seeing mid 5% deals on stabilized permanent debt. So, from a 30,000 foot view, the economy is very strong. We're seeing inflation move up. The Federal Reserve's really kind of they're checking off all the boxes that they want to check in order to do another rate hike or two this year. So, I'm not an economist, but I think, if I were a betting man, I would bet that we're going to see those rate increases this year.
Well, it's going to be interesting to see what happens with the cap rates. And of course, everybody seems to think that, and there's not as much of a correlation that most people believe there is between cap rates and interest rates. There is a correlation, but it's not as tied 1-to-1 like many think immediately.
Right.
But it is going to be interesting because there was so much compression between the 10-year rate and treasuries. And now you're continuing to see that 10-year creep up. So you're really compressing that gap even more, that spread, which as a lender is dangerous, right?
Absolutely. Yep.
You're giving less margin on that deal. If you're underwriting it at a 6 cap and you're borrowing at a 4.5 cap, there's a 150 point spread to get additional cash on cash return, and you're compressing that spread right now. So was there nervousness about that happening at the show this year where people were talking about that? Or they don't care. I don't know.
Yeah, I wouldn't say that there was nervousness, and I wouldn't say that people don't care. It's something that's being acknowledged for sure. It's something that is kind of being built into underwriting and is in the back of everyone's mind on the lending side. As far as movement on cap rates, that's been, that's correlated with the movement in treasuries. Cap rates really haven't started moving up yet. Most of what I have read is that there was, as interest rates move up, there is room for, properties to or the market to absorb an interest rate move without cap rates having to move at a 1-for-1 pace, like you said.
Sure.
But as we get into the, mid 3s, the higher 3s on the U.S. Treasury rate, it has to move. It's going to have to start, cap rates are going to have to start creeping up. I think you're going to see a slowdown in deal volume across pretty much all property types, but probably more specifically multifamily at first. But yeah, as far as transactions, trades, interest rates are going to have an effect at some point. We haven't quite gotten to that point yet.
Mm-hmm. And did you get any feeling, or did people just have any discussion about which kind of properties they feel, or any segment they're more comfortable or feel more secure in, or which are more risky?
Sure. Multifamily is still kind of the belle of the ball, if you will.
And that's so interesting because every graph you look at, it's at the top of the cycle.
It is. Yeah. I mean, prices have, more than surpassed their previous highs. Market fundamentals remain really strong on the multifamily side. You're seeing record rental rates, operating efficiency, across the board. And until we really start to see kind of this, this pipeline of new development come onto the market and get absorbed, I think it's going to stay that way. Now, as interest rates move up, I think you're going to see a slowdown in the volume of multifamily trades because, the leverage that people want, which is that 75 to 80% leverage, it's not going to be there. And it's going to be because of debt coverage constraints, which I will, discuss more in the Fannie and Freddie topic.
Well, let's get into that's the elephant in the room is Fannie and Freddie. That's the gold standard for particularly, that's what it's signed for is on residential housing, multifamily. And so what are we looking at from those guys? What are they talking about for 2018?
They are, to put it bluntly, still very bullish on the market, still very bullish on multifamily properties. I would say outside of kind of the private debt funds and bridge type financing, agencies really dominated the MBA conference. I think you have somewhere in the mid 20s of Fannie lenders and mid 20s of Freddie lenders, and they all seem to be there. They all wanted to meet with all the mortgage brokers, bring us deals. I think the economists at Fannie Mae and Freddie Mac, really kind of supported what everyone, all the dust lenders were, had been thinking is that this is still a very strong market and the fundamentals are there for us to keep lending.
And can we stop just for a moment? Because this is a question that we get repeatedly. Folks ask us, you keep talking about agency debt. What's so great about agency debt? Obviously, people that are using it, they get it, they understand. But assuming that we're going to have listeners on the show today that don't understand why that Fannie and Freddie, the agencies, are considered the gold standard for multifamily investors on the debt side, can you give just a couple of bullet points of why that's the case?
And also just, for people who don't listen that much, what Fannie Mae and Freddie Mac are.
Sure. So Fannie Mae and Freddie Mac are government-sponsored agencies, which is, where the agency financing term, I believe, is derived from. Basically, what you're looking at when you're looking at a Fannie Mae or Freddie Mac loan is a long-term, typically non-recourse 30-year amortization with probably the most competitive pricing out on the market. Now, there are life companies out there that will beat an agency loan on pricing from time to time, but you're looking at probably 60 to 65% leverage. If you want 75 to 80% debt and you have to have non-recourse and you're looking for an interest only payment for the first 2 to 3 to 5 years, Fannie Mae and Freddie Mac are where you want to be. Now, they only lend on multifamily, seniors housing and affordable housing. There's no commercial, retail office programs from Fannie Mae, Freddie Mac. It's got to be there's got to be a residential component to the loan.
And there's a chicken and egg scenario to it also, because the second most common question we get from folks is, you guys love Fannie Mae and Freddie Mac and you make a compelling argument, so let's go get us a loan. Well, if you're not a key principal in a previous loan, you're not going to be really eligible for getting agency debt right off the bat. Mm-hmm. So there's a chicken and the egg. And that's something that a lot of people don't understand. I think I feel the need to reinforce that because that's a continual question that pops up.
Yep. And that's, you're very accurate. It is very challenging for a new borrower to go out and get Fannie Mae or Freddie Mac debt. And I wouldn't say it's necessarily if you haven't had a Fannie or Freddie loan before, but it's if you haven't really owned multifamily before. If you've owned multifamily, you've built up a portfolio, you've financed it through banks or life companies or CMBS, and you can show a proven track record of operating history.
As a key principle. Yeah.
As a key principle, correct. You can likely qualify for Fannie Mae or Freddie Mac. If you show up without any real multifamily ownership or ownership experience, you're probably going to be shown the door and said, come back to us in a few years when, you're ready.
So Eric called it the gold standard. So it's the gold standard. Why? Because it's non-recourse and also because it has really low finance terms and long time horizons.
Yeah, it's very competitively priced. Right now we're seeing spreads on agency debt in the, call it 150 to 250 basis points, which makes, pricing in the, call it low 4s to low 5s right now. And yes, it is non-recourse, which is very important to a lot of buyers, a lot of, borrowers. And you get a 30-year amortization. So you really get to see that cash flow. You get interest
banks
only.
Are 20 years typically with the banks.
20 to 25 years is typically the absolute max from banks. But yeah, when you get to recognize the cash flow that you do through a 30-year amortization, you get a non-recourse loan, you get max leverage, and you get, if not the best, close to the best pricing out there. That's really why it's considered the gold standard on the multifamily side. Interest only is very prevalent. We just did a loan, last month that closed with 5 years interest only, stabilized deal, no real construction or heavy value add component to it, but they offered 5 years of interest only. The borrower took it. So for the next 5 years, interest only payments, and they can really kind of juice the cash flows on that asset.
So Fannie and Freddie are for the big guys, the big players. Is there any participation for smaller players?
Yeah, like what's the range on the Fannie and Freddie side, the agency side, in terms of size?
Sure. Sure. Yeah. A lot of people, it's a commonly made mistake is that Fannie and Freddie are for properties that are, valued at $10 million and above. And you got to have, it's got to be a giant size loan to qualify. That's really not the case at all. Fannie Mae, Freddie Mac both have rolled out small balance programs, and they're extremely active. They have, maybe even more so than the conventional program, which is really for the, call it $8 million and up. Fannie Mae and Freddie Mac small balance programs are dominating the $1 million to, call it $7.5 million range.
Wow.
The loans are structured similarly, if not identically to the conventional programs. You get non-recourse, you get 30-year AMs, there's interest only periods available. You get very competitive pricing. The pricing's not quite as good as, it would be on a $25 to $50 million loan, but it's still very good. We're seeing a lot of people in the private client space, your mom and pops or your family offices who are purchasing multifamily assets take advantage of the programs, the platforms that Fannie Mae and Freddie Mac have rolled out for small balance loans.
Awesome. So, is there anything else that Fannie and Freddie, we don't want to give them short shrift. I mean, obviously they're the 800-pound gorilla in the room. Is there anything else we want to cover on Fannie and Freddie? Because there's another pretty big one out there we want to talk about next, which is CMBS.
Yeah, I think I kind of covered everything I wanted to on Fannie Mae and Freddie Mac. They're very active. If you're looking at multifamily properties, certainly give Fannie Mae, Freddie Mac a look, as you may be surprised on the structure of the loan that they offer to you. Okay.
And so CMBS, that's another biggie.
Sure.
That is commercial mortgage-backed securities. Although the commercial mortgage-backed security business, they package these into securities and then sell them in larger tranches out into the market. It was very prevalent in residential, has been very prevalent in residential for a long, long time. CMBS is really more of a probably since 1995-ish, something like that.
Right.
But it's still a significant part of the market, and it's a very attractive part of the market as well, too. So what's going on with the CMBS?
And it was also a huge part of when the market got into trouble and
right.
How they reacted.
The CMOs and CDOs and all that stuff.
Exactly. Yeah. Now the CMBS was one of the, first and biggest dominoes to fall, in the last downturn. Right now the CMBS market is healthy. The giant wall of maturities from, the last cycle, 2006, 2007, we've gotten past all of that. I believe
that was going to be Armageddon.
Yep. It was supposed to be Armageddon.
It was going to be Armageddon. The world was going to end.
There wasn't going to be enough money out there for people to refinance out of those CMBS loans. That turned out not to be the case, and not even close to the case. I think
the amazing thing about all of this, and it's, it'd be so much of a cynic, but if it's on the cover of US News and World Report, on Time and Newsweek, the chances are, particularly in our industry, it's wrong. They talk about the market booming. The market's back. It's booming. Run for the hills.
Right. Right. Yeah. No, it was, I don't know if it was misreported, but I think it was miscalculated. The amount of capital that was going to be out there to, get people out of those commercial mortgage.
A lot of people just blended and extended, didn't they?
Yeah. There was a fair amount of that. I think a lot of people kind of, as prices continued to rise over, the past, call it 7 to 8 years, a lot of people sold and got out of those. They paid, their property had appreciated to a level that they could afford to pay off those, pretty restrictive prepayment penalties. A lot of people decided to refinance over the past few years, maybe even before their loan was open to prepay. So, as far as I know and as far as I've read, the commercial mortgage-backed security lenders had very little defaults, or very little default, action in the past couple of years. And we've really gotten past that giant wall. Fast forward to today, CMBS and Fannie Mae, Freddie Mac, when I first came into the industry, they were competing head to head on multifamily projects. It was, you could go really either way. Over the past few years, that's changed, and CMBS is not quite as competitive on the multifamily side.
Well, banks have to take a piece of the pie now, right?
Right, exactly.
Before they could just push it down the road, and now that they've got to get their piece, they've got to take a risk piece of it.
Right.
And so now they're much more cautious and the pricing's a little different.
Right. And that's, that was a big concern last year. Heading towards the end of the year is how are these CMBS lenders going to kind of absorb that additional risk that they had to take on? It was a big topic of discussion, and, all the major commercial real estate publications is, this is coming. How is this going to affect the market? And truthfully, from what I saw, it really didn't affect the market. CMBS lenders have, I think, taken on an extra level of responsibility and accountability in this cycle, and they're not making the same kind of risky loans, likely because they now have a bigger piece of the risk profile. But they're being more logical and more reasonable in the assets that they're lending on and the leverage points that they're they're lending on, and to the borrowers that they're lending to.
Well, I was going to ask, are they as concerned about the pedigree of the borrowers as Fannie and Freddie are?
Yeah, it's tough to really answer that on a whole, or as a whole. I would say, CMBS certainly is very sensitive to borrower, credit history, bankruptcies, foreclosures, anything like that is going to be looked at with a lot of scrutiny. Is it an absolute deal killer? No, but you better have a good story, and you better show some cooperation if you have a bankruptcy or foreclosure, on your credit history.
Okay. Give us a 30,000 foot view of what a deal structure is going to look like on CMBS right now.
So on CMBS, you're looking at either a 5 or 10 year term. I would say probably 90% of CMBS deals that get done are 10-year terms. Like Fannie Mae and Freddie Mac, you're almost always looking at a 30-year amortization schedule. Pricing right now on CMBS is, call it swaps plus 200 to 215.
Swaps, you need to speak some English to us, brother.
Sorry about that. 10-year swap. So that's, okay. It's an index that follows very closely, with treasury rates. Okay. So, 10-year treasury today is 3.01. I believe the 10-year swap today was 3.04. So they're, not always that tight, but typically, within 5 to 10 basis points of each other.
Anything else on CMBS?
No, I would say as far as CMBS goes, it's kind of the product that most similarly reflects a Fannie Mae Freddie Mac loan, and it's available to all property types. It's really a great tool and vehicle for office, retail, self-storage, hotels.
So other things besides multifamily.
Pretty much anything besides multifamily if you're looking for long-term fixed rate non-recourse deals.
Deal size?
3 million up to, hundreds of million.
Yes.
So really not in the lower in the lower range, like the 1 million plus?
Typically not. No.
It's going to be more your bank deal.
Yep.
And so non-recourse?
All non-recourse. Yeah.
All non-recourse on the CMBS.
And that's hugely important to a lot of people.
Right.
Well, let's go traditional. What's going on in the banking world?
Yeah, banks are extremely active as well. We do quite a bit of banking or bank business. Anyone from your very small community bank to up to your Wells Fargo's, your Regions, PNC Bank. There's a lot of banks out there with an appetite for commercial real estate properties and investment. Banks they're starting to really kind of cut back on leverage points. Typically we're seeing 75% is an absolute max, and that's got to be kind of a sweetheart cherry deal. Right now, 65 to 70%. And I'm talking about stabilized properties, with cash flow. 65 to 70% is where a lot of them, want to top out.
How about in development? Are any of these lenders, is any particular segment better for developers?
What do you mean by that?
Well, I mean, some people want stabilized. So some lenders want stabilized properties. They prefer.
Some won't touch development,
and some won't touch.
Oh, okay, yeah, I mean, there are banks that are particularly adept to putting out development construction financing right now. There are banks that are really pulling back from that side of things. We've seen quite a bit of development over the course of this cycle, and there are banks out there that are just kind of saying enough's enough. We're not taking on that additional risk anymore. We'll put out money on stabilized products, but as far as bringing stuff out of the ground, that's no longer for us. In terms of product type, I would say multifamily and retail are probably still the easiest to get construction financing on. Hotels are very difficult. Office is difficult unless you have a very large amount of pre-leasing that has happened. Industrial it can go either way. It's got to be pre-leased. There's not really anything on the commercial side. You're not seeing a whole lot of spec building. Multifamily is really the only one, and naturally because of the business model, but multifamily is really the only one that, you don't need any real pre-leasing right now to get construction financing. And,
from the banks, are they insisting on recourse?
On the construction, yes. I mean, you're always going to need to provide at least a completion guarantee through CO. And then probably 95% of the time, it's going to be a full recourse loan, if you're doing a mini perm. There are banks out there that have started, doing limited recourse or a recourse burn off as, properties hit certain performance metrics. And there are a handful of banks that will do non-recourse loans, at a given leverage point. Typically that kind of key number is 60 to 65% for a bank to even consider non-recourse as an option. But for the most part, your community and regional banks are going to be asking full recourse.
And so if you're recourse, theoretically, it's a little bit more of a secure deal. Are you seeing a reflection of that more security in a little bit lower rates as compared to the CMBS deals, or no?
No, you're really not. It's really kind of a function of their pricing is what their pricing is. And they're not really pricing in a premium for a non-recourse deal from what we're seeing. Like I said before, it's kind of hard to put everything under one umbrella, all banks under one umbrella. But for the most part, we're seeing banks that, they have their pricing model, and, it's driven off deposits and borrower and deal type. But as far as recourse, if you can get recourse, it's probably not going to affect the pricing too much, or it won't be a material change in pricing.
So what are you seeing in banks, the change in attitudes and how they're approaching deals now?
Yeah, I mean, throughout Florida, like I've said, banks are still very active. They're out there. There's an appetite for commercial real estate investment. As I've already alluded to, a reduction in loan to value, loan to cost is very common, these days. And we're starting to see those price increases start to take place with the increase in treasury rates. Like I said earlier, pricing is now in the mid fours to, high fours to low fives. And I think it's only going to probably keep trickling up from here.
Life insurance companies also a pretty big player in the market.
Sure.
So tell us about what's going on with the life insurance co's.
Yeah. So life companies, I would say they're active, but they're selective in what they're lending on right now. Life companies have always kind of been the premier pricing avenue, but it's for better capitalized borrowers. Typically 65%, maybe 70% is really the top of the leverage point that you're going to get from a life company.
And are they looking for recourse only, or are they doing non-recourse?
Life companies vary quite a bit. Non-recourse is very common with life companies, but there are some now that are starting to, put out deals that are either partial recourse, 50% personal guarantee, or even, for riskier assets, a full guarantee. But for the most part, you're seeing mostly, non-recourse, structures.
Okay. Sort of a 30,000-foot view on how they look compared to the other ones, the other four we've discussed?
Yeah. So, life companies, they're still active in development and construction financing. They're very strong when it comes to credit tenant, retail, credit tenant office. They're not going to give you as much in proceeds as you can find elsewhere. But in terms of pricing, they're going to be, if they like a deal, they're going to price a deal to win it. So, I would say life companies are definitely, still very active.
There's one issue I'd like you just to address, and I'm thinking of a life company in particular, and inflexibility. Like if you have to refinance, you're really locked into what you've got because they've gone out and they promised their investors yields.
Right.
In terms of like the categories we mentioned so far, are there any that are more flexible, like with a bank or when defeasance kicks in, particularly with life insurance, that's a stiff penalty. Does that apply?
I think they all have.
Do they all have that?
I think they all have pretty steep defeasance penalties, and that's my experience.
Yep. And no, you guys are absolutely right about that. In terms of prepayment penalties, CMBS, life companies, and Fannie Mae, Freddie Mac all are probably the most restrictive. You're looking at yield maintenance or defeasance typically, with any of those types of lenders. Fannie Mae and Freddie Mac have started rolling out programs where you can pay extra in rate for a more flexible prepayment penalty on the backside. CMBS is always going to be yield maintenance or defeasance, most commonly defeasance. And life companies are the same. Banks are by far the most, flexible in terms of prepayment. Some banks, if you're doing a bank deal where they're doing a swap, then you're most likely going to have yield maintenance, but that's not as common as, just your common step down prepayment penalty, or even we're seeing banks put out deals that have no prepayment penalty. So, it just, if that's a hot button for a borrower, then it's something that, we need to go find, bank financing probably if they want the flexibility to sell here in the next 3 to 5 years or whatever their investment horizon is.
Okay. So we've talked about the four major options that you'll have on the debt side. But if you don't fit in the box of the other four, there are other options for folks, right? How would they go about finding them, and what would those other options be?
Yeah, there's a lot of, there's kind of a lot of new players coming to the market in terms of debt funds and, mortgage REITs. And, I would say and I alluded to this earlier in our conversation, but outside of, Fannie and Freddie, kind of your bridge lenders were the most, I would say, saturated within the MBA conference.
Explain what that means.
So
mezzanine financing, bridge financing is kind of the same thing.
Right.
Yeah.
So bridge financing is basically financing for a property that can't really cover the debt service of a property right
Doesn't
now.
fit in the profile of the other four lenders.
Exactly.
It's going to take them a year or 2 years to get it stabilized.
Yep. There's a heavy lift value add type program. There's a repositioning component to the asset. Basically you're paying a premium to get to the leverage point, that you could with a stabilized deal. But now, you're paying, call it a 5.5 to 6.5 coupon on a deal. And typically you're getting interest only, financing. They're shorter term deals. It's 2 to 3 years. And, it's really a vehicle set up for someone to come in and acquire a property or, typically acquire a property and reposition it and then, either sell it upon stabilization
or
refinance into permanent debt.
What about like hard money lenders and all these other kinds of lenders? Did they come to the conference at all? Or?
Yeah, absolutely. And that kind of hard money lenders kind of fall into that same category that I'm speaking to in terms of non-traditional or alternative lenders. They don't fall into the major four food groups of, Fannie, Freddie, CMBS, Life Company, and banks. I would say right now we're seeing kind of three different classes of alternative lenders. It's your institutional style bridge lenders, mezz lenders who are, pricing deals in the, like I said, 5.5 to 6.5% range with today's rates. And then there's kind of your mid-level, bridge lenders who are pricing things more in that 7.5 to 9.5% range. They're more your medium-sized funds. And then you have your very private hard money lenders who are typically doing, smaller deals, call it in the $1 to $10 million space. And they're charging, coupon in the 10 plus range. So, I think we're seeing more bifurcation, in the alternative lender space than maybe we have before. But I don't know that that's a bad thing.
So how do you work with a client that comes to you? They come to you, tell you about the deal that they want to do. And, do they tell you what direction they want to go, or do you help them figuring on what it is?
And all these buckets, are you filling all these buckets for them, or would you?
Sure.
So foreign money. I mean, you guys have access to foreign money?
Yep, absolutely.
Okay. So you've got all of these different buckets that you can take out of to help structure that deal.
Mm-hmm.
Okay.
Right. So, a lot of times, and the answer to that question, I guess, is twofold. Sometimes a client will bring us a deal and he knows exactly what he wants. He just doesn't know where to go find it. On the other side, sometimes a client will bring us a deal and they kind of tell us what they want. And it's part of our job to kind of decipher, okay, here's what's important to them and here's where we need to place this debt or equity.
We call it the come to Jesus period.
Exactly. No, it's,
that's a period where somebody has this expectation of A,
yep,
and they're really at level D.
Yep, exactly.
And you have to explain to them, and it's hard because they're going to keep knocking on a door until someone says, "Oh yeah, you're a level A."
Right.
And anyway, we all been down there.
Eric's the former banker talking now.
No, it's really an interesting time in the market and an interesting time to be coming up in this industry. There's so many different capital sources out there and capital providers and people who are, very clever and looking for deals to do. I always tell someone that, that brings up, I see in passing at a networking event or, just around town, on the weekend, like, hey, I got this deal. I don't know if it'll work. Well, let's have a conversation about it. Right. I mean, there's, in my opinion, almost always someone out there that'll put together a deal for you. Now, it might not be your ideal terms. It's going to be that come to Jesus moment, but we can make a deal work. So let's have a conversation and see, how these pieces are going to fit together.
So Casey, we've been through all these options. I want to get a loan. I want to do a big project. How can I reach you?
Sure. That's a great question.
What's the process?
Well, the process is to, there's multiple ways to meet me, honestly, or get a hold of me. You can go to our website, www.franklinstreet.com. You can reach me at, casey.siggins@franklinstreet.com. Or, on our website, all my telephone numbers are on there. And, really the process is you reach out, you say, here's my idea. Here's this project I'm looking to buy or develop or refinance. And, what do you think we can do? And we just have an honest conversation.
And should we come to you before they've even put a contract on, or when the property's tied up? Is there any optimal time to?
Yeah, I would say, before the contract is in place is fine. Typically, we can't really allocate a ton of our resources and time to something that's not under contract, but we can certainly have a conversation and say, here and give some guidance, really. Here's where I think market rates are and what kind of structure you're going to see, depending on the situation, the specific situation. But you can call us at any time. If you have a loan that you thought you had in place with a community bank or a life company and it blows up 2 weeks before closing, we have lenders that can close in 2 weeks. So from identification of the asset to really the closing, a day before closing, we can probably help you out in some way.
Awesome. Casey, really appreciate you coming in and talking to us today. I think it's valuable for our listeners to keep up to date on what's happening in the debt markets. Obviously, real estate is a business that makes the most sense when you can get leverage. It's a big boys game, and it's important that investors stay on top of what's happening with the market. So really appreciate the time you invested with us today. Stephen, anything else before we let Casey go?
Casey, thank you for the update. I mean, actually, when you think about it, your biggest partner is the bank, so it's important to keep up to date, and we appreciate that.
Exactly. Well, I really appreciate you guys having me. I really enjoyed the conversation and look forward to doing it sometime in the future.
All right, buddy. Thank you. And that was Casey Siggins of Franklin Street Capital Advisors. Interest rates are going up. You guys need to be paying attention to what's going on. Which one of these lenders are going to blink in terms of the rates, which are going to fare a little bit better in this rising interest rate environment. These are certainly things that were covered in the MBA conference that was just held, and Casey gives us a great recap of that situation. Stephen, what were your thoughts?
Eric, choosing a lender when you're going into a deal is critical, and you need to select carefully. One lender may have a rate that's lower than another, but they may be less flexible. So you need to plan what you want to do with the property. Are you going to hold? Are you going to sell? And then select the lender accordingly. I think having an advisor like Casey can be very helpful in making a successful investment.
Absolutely. Casey was a great guest. Stephen, we've got lots of great guests that have spoken to us over the, I guess we're moving on 4 years now of the Invest Florida podcast. Where can folks get more information from other speakers that we've had in the past?
Well, one is from the website, www.investfloridashow.com. You can also listen to us while you're mobile, download the apps, and listen on your mobile device in the gym or in the car.
Guys, as always, we appreciate the time that you invest with us. And until next time, hasta la vista.
You've just listened to the Invest Florida podcast with Eric Odom and Stephen Silverman. Join us every week for actionable real estate investment ideas, and of course, visit our website at www.investfloridashow.com for more shows and tips on how to earn a cash flow in the real estate market in Florida. While hosts and producers of the Invest Florida show have no reason to doubt the validity of comments of our guests, we do not warranty their accuracy. Please check with your legal, financial, and tax advisors before entering into any investment. Returns will vary from person to person and deal to deal based on unique circumstances. All information expressed in this show is for educational purposes only. Opinions of the guests are not necessarily shared by the hosts and producers of the Invest Florida show.